Good afternoon, ladies and gentlemen. Welcome to the Barometer Readings Monthly Conference Call. At this time, all participants are in a listen-only mode. Following the presentation, we will conduct a question-and-answer session, at which time instructions will be provided. For operator assistance during the call, please press star 0. I would now like to turn the meeting over to Sarah Petoskey. Please go ahead.
Good afternoon, everyone. Thank you for taking the time to dial in today to the Barometer Readings Monthly Conference Call. In light of recent market volatility, this is a great time to communicate our current market views and actions we have taken to preserve capital and avoid areas of deterioration. During periods of corrections like we are seeing, our disciplined leadership approach forces us to take action. Therefore, we've been actively hedging the portfolios and raising cash to reduce our market exposure. We are pleased with how the portfolios are positioned and our ability to protect capital during this volatile period. Year to date, as of January 19th, our portfolios are down around 3% on the equity side, the equity fund, on the balance down around 1.2%, and basically flat on the income, and with our global macro pool being up over 2% as of January 19th. And that's relative to, the S&P and TSX being down approximately 8%. I'll pass it over to David Burrows, President, Chief Investment Strategist, who will provide you with some context on the current market environment and speak to our portfolio positioning and highlight changes we've made during these past few weeks.
Hey, folks. Thanks for taking the time to tune in today. Let me just step back for 2-3 minutes and position things a little bit. I think that, you've all spent time with us and understand that, our objective, and I think the objectives of our clients, is to work at generating returns with a risk characteristic that they can live with. And so, we spend a lot of time talking about the fact that over a long period of time we see every kind of market environment you can imagine, and that the world changes, and you have to be prepared to recognize that change, and from time to time that means changing the portfolios pretty dramatically. And so this is, I think, what we're charged with by the clients. And from time to time, we wind up in situations where sectors or whole asset classes go out of favor for some period of time, either for a short term or something longer. And I think that we have to be prepared to do something about it. So there's times to make money, and there's times to make sure we're not giving it back. And when we give our presentation, we talk a lot about how, the thing that we're most proud of is if we go back to the very beginning of the firm, both in our equity strategy and in our income strategy, if you took any rolling 4 or 5 year period, whether it was in equities like 91 through 94 or 97 through 2001 or 2000 through 2014, there's going to be a period in there of weakness almost always, and there's going to be some strength in there, and the job is to take advantage of the strength and make sure we don't give it all back. So rolling periods, I think, are important to us, and our job is to try and beat the benchmark that we have for each mandate over those rolling periods, but do it with considerably less risk. And you never know when these times are going to come. So as I think we have been of the view that the developed consumer-led equity markets exited a structural or secular bear market at the end of 2012, and we entered a period where we would likely see sort of rising multiples, more sustainable gains, marked by short, sharp corrections, but where equities as a whole, and especially developed market equities, would outperform as an asset class. I think that our view has been pretty consistent, that the structural shift for consumer economies is advent of plentiful energy, and of course more recently, since 2014, low-priced plentiful energy, and that does marvelous things for developed consumer economy, especially like the U.S., where 70% of the economy is driven by a consumer. So we spend a lot of time trying to focus in areas that benefit from that. In the early part of the boom in production, it was pipelines and processors and service companies and producers. And in the summer of 2014, the breadth models that we use to track whether money is getting put to work in a universe of stocks or being taken out, We saw a deterioration in the percentage of stocks doing well in the summer of 2014, so 18, 19 months ago, and that forced us to take our allocation to energy down. And at the same time, we saw improvement in the models that we use in sectors like consumer, which included staples and discretionary, healthcare, technology, and financials. So as a result, over the last 18 months, we've been very focused in the U.S. market geographically. We've been very focused in those sectors. We've been focused in dividend growth theme. And I think that has been the right positioning. That doesn't mean that you don't get corrections. When we give our presentation, we often put up the breadth chart of the 1980s, which was a 10-year bull market for stocks. And in that decade, there were 5 distinct corrections where breadth went from sort of 70 or 80% of stocks doing well to, by the time the correction was done, somewhere south of 30% of stocks holding up in price. And in each one of those periods, when the percentage of stocks doing well got below 30 and eventually turned up, it was a scary time. There was lots of things to worry about. But in every single case, it was time to put money to work. And that's where you get the opportunity to be a contrarian investor. And so when we fast forward to where we are today, if we go through 2014, globally, the percentage of stocks doing well started to weaken in April of this past year. And that was really predominantly driven by money leaving emerging markets and the commodity-led markets like Canada. And money was rotating to the U.S. And so the Canadian breadth models weakening over the last year have taken us away from Canada and pushed us more to the U.S. We know the U.S. market has been outperforming now for 2 years, as has the U.S. dollar. Now recently there's been a lot of discussion, are we headed into a bear market? And a lot made out of the fact that the first couple of weeks of 2016 is sloppy. Now, let's take a step back. When we talk about how a correction unfolds, we always say that the weaklings sell off at the beginning, and as a sell-off picks up steam, it will impact a broader and broader list of securities until towards the end of a decline, if it gets bad enough, the market's coming back and getting the leaders. So let me put things in perspective. Since last May, starting from the markets that have been hurt the most, Dubai, as of yesterday, was down 48%. The Chinese stock market was down 41%. Brazil, down 37%. Portugal, down 36%. Poland, down 34%. Qatar, down 33%. Hong Kong, down 31%. And we could keep going down the list, but eventually we're going to get to Sweden, down 22%. Taiwan, down 23%. Germany, down 21%. Canada, down 22%. Keep going down the list, and at the bottom of the list we're going to get to the S&P, which as of yesterday was down like 12% in the morning. And so there's been a lot made of the fact the market's been falling out of bed, and we know that that's true. In early December, the percentage of stocks performing well in the U.S. equity market started to weaken. And they started to weaken actually in some of the groups that have been holding up through the weekend. Now we know the Russell 2000 has been weakening for months, and we know there's lots of sectors in the U.S. market like industrials and transports that have been underperforming for a long time. But in a bull market, you tend to have some haves and some have-nots. The haves are the ones that are benefiting from the structural shift. And in the U.S., that included the consumer discretionary group and technology, those FANG stocks we talk about. But we started to see some weakness there. So as we do, when we see deterioration in breadth, first of all, our sensitivity to our stop losses is heightened. In other words, we tend to tighten them up closer to current market price. We tend to raise a little bit of cash. And as we get stopped out, we don't put new money to work. And through December, we got stopped on a few positions. Obviously, it was a sloppy market. But the other thing that we can do in our pools and the funds that we manage is we can hedge them versus the market. We can sell S&P 500 futures contracts and effectively neutralize some portion of our exposure. We did that versus the NASDAQ and the S&P. And by the end of the year, exited the year virtually 100% hedged. And we did that because while we were seeing weakness in other parts of the market, we saw weakness creeping into the leadership of the market. Now go back to that discussion we started with, was late in the decline you start to hit the leadership. We know that the epicenter of the problem and the reason that emerging markets have underperformed now for 2 years is China's slowing. And as China slows, that has a negative impact on other emerging markets who are suppliers. It has a negative impact on the commodity producers. Has a negative impact on energy. It has a negative impact on markets that are more commodity driven, like Canada and Australia. It has an impact on currencies. As you go in concentric circles away from the epicenter, the impact is less and less. The furthest market from the epicenter is the U.S. domestic consumer-led market. The U.S. exports very little to China. They import stuff from China. Deflation in price is a pretty good thing for a U.S. consumer. And so when you think of the stocks that got hit over the last month, stuff like Amazon and Netflix, really have nothing absolutely to do with China. But eventually, when things get tough, emotion gets higher, people lose their confidence, and the selling starts to hit the leaders, whether or not they have something to do with where the core of the problem is. And it's not for us to say that they're wrong, it's just to recognize it and deal with it. So as a result, we wound up hedging up the portfolios. So emerging markets are partway through what is likely to be a period of 8 or 10 years where money generally leaves emerging markets in favor of the market that's benefiting from the structural shift, the U.S. and other domestic economies. So we're not saying we're anywhere close to doing something there. We've had no exposure for 3 years. We've had no exposure to commodities since the last of our commodity exposure left the portfolios in 2014. We've had very little exposure to Canada. And we expect that structurally it's going to take time for a restructuring in China, a restructuring in commodity companies, and for growth to come back. Like the bear market in Japan that started in the 1990s, there's likely to be bounces in those asset classes as things get oversold, but less tradable and less interesting to us. So we would say that the emerging markets issue is going to go on for some time. Commodities are going to go on for some time. There's going to be some respite from time to time that are going to be trading rallies, which we're not so interested. They're not sustainable themes. And on the other side, consumer economies are going to have a general tailwind, and from time to time we're going to get a pinch point coming from one of the structural problems that might scare people, and we're in one of those periods now. So spreads now in the U.S. stock market, the percentage of stocks and long-term advances is sitting at 20%. So going back to that 1980s chart, which we often show, there were 5 times in the 1980s spreads got below 30%. We're sitting right now at 20. We're sitting at the same level it got to at the worst point of 2011. Our short-term indicators are as sold out as they have been since 2011. Doesn't mean they have to turn today or next week, and we recognize that, and that's why we're hedged. Having said that, many of the positions that we have in the portfolios have held up remarkably well, like a Microsoft or a McDonald's or General Electric. These are companies generally with very strong balance sheets, have very little credit risk, are showing great numbers. Starbucks tonight reported 8% same-store sales, beat on estimates. Nike, most recent quarter, grew their sales in China by 30%. So there are some natural winners in this market, and those are the things that we think we're holding in the portfolios. They're the furthest thing, it happens to be, from the epicenter of the problem, which is China. In the short run, we are hedged, and that is to minimize the impact of market risk. Things that we don't see. we don't see a spike in volatility like we did in 2011 or anywhere close to what happened in 2008. That points to the fact there is not a structural credit risk problem in the system. Correlations, the degree to which stocks behave the same, has not gone to 100% like it did in previous corrections in the secular bear market. Correlations have actually stayed relatively low. There are some winners and there's some losers. By nature of the fact that the bullish percent is at 20%, it means that 20% of stocks are actually still holding up technically. They may be pulling back within their themes, but they're not broken. If our positions hit stops, we will exit. That gives us an opportunity to reduce our hedge. But I will say it looks to us like we are way closer to the end than the beginning of this correction. So we go back to the question that everybody's asking, are we headed into a bear market? There's a lot of countries around the world, specifically emerging markets, that have been in bear markets for a long time, and that's why we're not there. The U.S. market has corrected, and it's a typical correction in a bull market. Corrections in a bull market are short, sharp, they're painful. They happen because there's things to worry about, like the 1998 Asian currency crisis or the recession 1990-91, but they tend to come and go quickly. So there are two previous examples. In fact, I put them up on Twitter yesterday, and at Barometer CA. At Barometer CA is our Twitter handle. And they highlighted the structural bear market that took place in the 60s and 70s. It broke out to begin a new bull market in 82. In 1984, 2 years into the bull market, there was an 11% correction that lasted about 9-10 months. There was lots of volatility. It was at the point where the question was, can this bull market continue? It worked its way through. The market turned higher and rallied straight higher for the next 3.5 years before the next correction. But that was one of the 5 opportunities in the 80s to put money to work. If you go back to the structural bear market in the 1930s and 40s, when the market resolved into bull market in 1950, 4 years into that bull market, there was a 9% correction over about 8 months that played out in a series of lower lows and lower highs, and then the market headed straight higher for the next 6 years. So these kinds of corrections don't come often. When they happen, people look backwards and say, well, maybe we're headed back into that awful world we were in back in 2008-9 or in a structural bear market. That is not the case from what we can see. So we are prepared at any point to reduce the hedges in the portfolio if our short and long-term indicators start to turn up. And when they do, that is what we do. We will take the hedges off. As it turns out, I'm excited about the fact that when I look at the portfolios, I talk about needing to do well over rolling periods. If you go back to December 31st of 2014, so a year and 3 weeks ago, since then, the TSX is down 18% on a total return basis. Since then, the S&P 500, as of yesterday, down 9.2%. The MSCI World Index down 12%. The TSE Income Index down 23.8%. That's a tough thing for private investors. The U.S. High Yield Bond Index down 11.6%. In that same period, our worst situation was the income portfolio down 6. The balanced up 2. The equity fund up 4. The global macro portfolio up 9.5. If we look at just this year, which of course is something that lots of people are concerned about, how are we doing so far this year? We know that the indices are down hard around the world. As of yesterday morning, the S&P down 10.5, TSX down 10.5, World Index down 11.7. Worst portfolio year to date, long short down 3. Best portfolio ETF up about 4. So we're virtually flat on the year across the pools and funds. This is one of those opportunities that gives us an opportunity in the 4-year period to really set ourselves away from the benchmarks Sometimes you do it on the upside, sometimes you do it by not giving back the downside. But the downside piece, I think, is the most important for the clients. I think that they should be comfortable knowing that they're hedged and outside of much by way of risk. I do think, though, shortly we'll see a reemergence in strength, and when that happens and the models turn up, I'm looking forward to taking advantage of the opportunity that's on the other side, and it probably means we'll have 2-3 years of pretty strong markets coming out the other side. But I'm not going to guess when that is. We'll wait and see when the models turn higher. So as it stands, the portfolios have been largely hedged so far through the year. Probably the biggest issue that I face is explaining why it was last year that we hedged the currency on the income portfolio, and that cost us for sure. Our sense has been that income investor is not prepared to make a binary bet on currency. If the currency had gone the other way on us, it wouldn't matter what the return was in income. It could have cost us a lot of money. The other portfolios were largely unhedged and didn't have the same issue. At this point, interesting enough, there's a lot of people who would love to own U.S. securities but are worried about the Canadian dollar bouncing back. And so the fact that it is hedged means you can buy those great companies without worrying about the Canadian dollar going from 68 to 72 or 73. The bottom in the currency in the 1990s was 66 cents. We didn't get too far from that yesterday. There's a penny and a half bounce today. I don't know where the lows are. The Canadian dollar is likely to stay pretty weak, but you can hedge out, you can minimize the risk of the Canadian dollar bouncing versus U.S. In that income portfolio. On the separate accounts, of course, we can't hedge. And so for the separate accounts we manage on the platforms, we've done our best to use stops and to use some cash and to keep the portfolios in pretty defensive positions. Our biggest weight has been consumer staples. And actually, on a relative basis, that group has behaved better than any group in the market. And so, again, we look forward to things. But when we look at where the breadth models are today, they are extremely sold out. And any time we've been at levels like this, you're soon to see them turn higher. And that will set up the next runway. And as I say, in a secular bull market, the rallies last a lot longer. The themes become much more concentrated. The leadership is persistent. And as it stands right now, I don't see anything that's going to take the place of consumer and technology as leadership in this market. And that's where the majority of the positions are. So with that, we're happy to take any questions you might have. And we just certainly appreciate you being clients.